Okay, so I've been having a few little hiccups getting this started, but I think I can start now. So we're going to be using CAPM, and then we're going to so we're going to find the Sharpe ratio, but we're going to start from scratch. So normally the Sharpe ratio would be used for valuing a portfolio, the expected return of the portfolio. But in this case, we're going to do an equity, and the equity that we're going to do today, I just chose at random, would be the Groupon. So the ticker for Groupon is GRPN. And Groupon is special because it was actually one of the first companies that I bought equity in when I was in seventh grade. So I bought it under my dad's account. So I gave my dad some cash, and he said, "You're not going to have less than 3 stocks." So I bought Groupon, American Airlines, and ticker JNUG, JNUG. I wanted to go all in on Groupon. But anyways, that's another story. So we're going to value Groupon. And the first thing we're going to do is we're going to use the capital asset pricing model, or CAPM as I refer to it as CAPM. So the formula for CAPM is the return of the investment is equal to the risk-free rate plus beta of expected market return minus the risk-free rate. So what I'm going to do is first we're going to get CAPM, and then we're going to do the Sharpe ratio. And then we're actually going to also use the current ratio. So I'll get to that in a second. So I have my notes here for what I'm going to do. So according to the Apple Stocks app, the beta for Groupon is 1.6, but let me double check. Beta 1.6, yeah. Okay, so we're going to write the return on the investment is equal to the risk-free rate. So the risk-free rate is about 4.3. Excuse me, is about 4.3, but let's be very precise. So for the risk-free rate, we're going to use the 10-year Treasury yield, which CNBC has it at 4.492. So 4.492 plus the beta of 1.6 times the expected market return. So what has the return been for the stock market for the past 10 years? I think it's 10-year average. Well, what is the S&P, return S&P? 10 years, 138%. So it would be the average. Index has returned a historic average around 11.88% since 1957 to 2021. So let's choose that. So 11.88. So 11.88 minus the risk-free rate of 4.492. So this is CAPM with actual with actual data. Let's see how we can position. See if this has any. Oh, my hairy arms. Okay, I think that looks okay. Well, that's gonna have to do. I'm going to erase this anyway because there's only so much room on this board. So we're going to actually, let's erase this, and then we can have some more room to work on. So 11.88. Let's use a calculator. And this is 11.88 minus 4. 0.492 is equal to 7.388, 1.6 plus, and then 4.492. So we multiply, so 7.388 times 1.6 plus 4.492 is 16. So 16.3128. So let's round to 16.31. So 16.31. So the expected return on Groupon for a year from now is, let's actually do percentages so that we know what we're working with. So all of these are percentages. Everything is a percentage except for beta. This is also a percentage. So everything's a percentage except for beta. So yeah, so we've got 16.31. So we can erase this. And then this is the expected return. So let's go on to the Sharpe ratio, which is, yeah, so we're gonna do, what's the term? What is it? Well, we'll just put Sharpe ratio. Sharpe ratio. I forgot what the guy's first name was, but his last name was Sharpe. So Sharpe ratio equals RA minus RB. So the expected return of the portfolio. Let's do, I don't know, I guess the portfolio, you can do sub whatever letter. I'll put A. It doesn't really matter, but we'll do A minus, I believe it's the risk-free rate, yeah, minus RB over the standard deviation of the asset. Well, actually, this is confusing. So return of the portfolio over RB. So RP equals return of portfolio. And I'll get to this in a second. RB is the risk-free rate. And then standard deviation of asset equals, standard deviation of the asset. Can you see that? Yes, you can see that. Okay. So now, what is this that we're looking at? So we want the return of the portfolio. Now, I'm saying return of portfolio, but really what I want to see is a return that is closest to me. Actually, let's look at what I did personally. So we're gonna look at the return of the asset, which we calculated from CAPM. Yeah, okay. Return of the portfolio. Sorry, I kind of messed up there. So it's not what I'm expecting. It's what the return of the asset is going to be. So normally you would use return of portfolio, but today I just wanted to use the return of the single equity. In this case, it would be Groupon. So we got from CAPM that the return is going to be 16.31. So we're going to use Sharpe ratio equals, it's not what I expect. So sorry, I should have okay, just pretend I didn't say that. So it's gonna be Sharpe ratio. Let's kind of divide this. So these are the definitions. return portfolio typically, but in our case, we're gonna do the return of the equity. So we can put RE. We're gonna do the return of the equity. So we can also erase this return of the equity. That's RB, which is the risk-free rate. So Sharpe ratio. So we gathered that it was going to be 16.31 minus the risk-free rate, which was, what was it? 4.4 what? 92. 4.492 over the standard deviation, which according to, it varies from website to website, like what exactly the standard deviation is, but according to Macro Access, the standard deviation is 7.57. 7.57, yeah. So that's it. So let's plug this in, and let's go to the calculator again. So we've got 16.31 minus 4.492. 492, yeah, equals that, which is 11.818 over the standard deviation, 7.57 is equal to 11. Yeah, well, we could do 11.82, but we're not rounding with the risk-free rate. This is just a flat 7.57. We're not rounding either. We just rounded here. I mean, it doesn't really matter. The difference is so small, so it doesn't really matter if you round. But so I'm not gonna round. So we're gonna do 11.818 just to be, I guess, more precise. But even though I'm not being precise here, but that the difference is so small, it doesn't really matter. So 7.57 equals, let's we can do this. So we already have the definitions here. So we can erase this. Sharpe ratio of 1.56. Yeah, and even if we round it, it still stays at 1.56. So now the Sharpe ratio of 1 is what we're looking for. A Sharpe ratio of 2 is great, and a Sharpe ratio of above 2 is great, and a Sharpe ratio of above 3 is excellent. So we've got our Sharpe ratio. So this is a pretty good. This is an acceptable. This is an acceptable Sharpe ratio. This might be it could be considered. So it's good, but it's not like it's not like something that's totally beyond what totally out there. So this is okay. We're gonna say this is okay. Now let's put this over here. Well, we already did this, so we don't need this anymore. We've got our Sharpe ratio, so we're gonna write Sharpe ratio equals 1.56, which is okay. So that's fine. Now we're going to do the current ratio, which is current ratio, which is the current assets over the current liabilities. And what does this tell us? This tells us If the company were to be liquidated and totally sold off, how are they able to meet their debt obligations? So, say I have assets. Say I have $100 of cash, and let's say in this theoretical world, all I have is cash, and I don't have a car, I don't have a house. All I have is cash, $100 to my name, but I have $200 in credit card debt. So that would be $100 over my $200 in credit card debt. My current ratio would be 0.5, which is not good. That's actually pretty bad. So, well, where do we get this information from? So, we have to look at their balance sheet. So we can go to my computer's right here. So we go to oh, sorry, let me move my computer. Okay, so we're gonna go to SEC GRPN 10-K. A 10-K is an annual report that every public company has to report this to the SEC, the Securities Exchange Commission. So, financial statements and supplementary. It's always item 8 is what you're looking for. Annual findings. Excuse me, 10K. Let's see. So item 8, financial statements and supplementary data. And we're gonna look at their balance sheet. So you go to get here, you're gonna go to you can go to anywhere. You can get it from the SEC website, or you can go to the actual company's website itself, and then you're gonna go to item 8. So you're gonna, whatever way you get there, you're gonna go to 10K, and then you're going to go to the item 8, and then you're gonna go to balance sheet. It might be consolidated balance sheet, but this is the way you get there. And then there's gonna be a bunch of numbers there. So what we're gonna do is we're gonna see assets, and then we're gonna see current assets. And then, so this is going to be a subsection of assets. So that's why it's the next line, but it's indented because it's still part of assets, but it's a subsection of assets. So you're going to have current assets, and then you're going to have total assets. So current assets are things that you expect to use in a year, within 1 year, within 365 days, as of the filing of the balance sheet. So the current assets, you're going to go down until you see total current assets. And in 2022, they had total current assets of 300. Let's see. I don't know where to write. What if? Okay, let's put current ratio up here. Current ratio. And then we're going to write what Groupon actually has, which is going to be 357, comma 351. Let's kind of divide this. So this is what we're looking for, and this is the actual applicable, situation. And then we're going to go down to current. Oh, I used the thick side of the marker, so we're going to do current, and then we're going to do liabilities. So it's going to be there, and we're going to do the same thing. So we're going to go to liabilities. There's going to be current liabilities. So actually, let's how about we do this, and then we do. It'll actually be under liabilities and equity. So assets has to equal the accounting equation is assets equals liabilities minus equity, but They might do liabilities and equity. It just depends, but yeah, either way, you're gonna find an item that says total current liabilities, which is 531. Now these are in thousands, by the way. It'll tell you at the top of the balance sheet in thousands, except share and per share amounts. So 531,440, which it's not looking great because we see that the current liabilities is above the current assets, and in the example I used of having $100 in cash, which would be the asset over the liability of 200, we know that if liabilities has a higher amount, is a higher nominal amount than assets, then we're going to have a less than 1 ratio. So current liabilities, this is not looking good. So let us calculate 351 divided by 531,440. So this computes a current ratio. Let's get rid of every little mark. Okay, so this computes a current ratio of 0.6724. So we had an okay Sharpe ratio, but we have a bad current ratio. So what does this tell us? Now you have to make a decision, because this is really a rough spot to be in using these ratios. Because say the Sharpe ratio was like 6, and then the current ratio is 0.9. So even though the current ratio is a little bit below 1, the Sharpe ratio is crazy. So that would outweigh this. Now it's up to you as the investor to decide. Okay, do you think that you have to go through their 10K and you say, okay, including their risk factors, including all qualitative data, including management changes, including macroeconomic factors, because we have high inflation. Groupon, which is like a coupon website, because we have high inflation, they're probably going to have more traffic because of the high inflation. They have less money in their pocket because wages aren't keeping up with inflation, which means they're really getting a pay decrease, their real wage is going down. So they're probably going to go into a coupon website. Now, you have to decide, will that increase in revenue raise their assets so much that it exceeds 531 and they have a higher current ratio? Or maybe it does. Maybe it goes up to 600,000. But their current liabilities go up to 700,000. They still have a less than 1 current ratio. So it's totally up to you. Now, to me, this current ratio is so bad that this okay-ish Sharpe ratio does not. It does not. The Sharpe ratio does not outweigh the current ratio. The current ratio is so bad that even a Sharpe ratio of 1.56 cannot justify it. So purely from a multiples and ratio perspective, it is not solid. Now there are other methods of valuation, but the problem is that with Groupon, their market cap is like 300, 400, like $600 million or something. So any slight change, any little rumor will totally, it's basically a penny stock essentially, because, even though it's trading at, 500 million or whatever the number is, it's really tough to say. Now they report earning. I have now just to say I have a position in Groupon because I decided this would be more of a long-term thing, but I decided, you know what? A lot of my portfolio is diversified, is pretty great. Let me put a small amount of my portfolio to bet that Groupon's going to go up because I do think that there will be an increase in traffic and they'll have increased current assets because they'll have more revenue. But I'm not. I bought the stock to kind of so if I was full in, on calls, then I would be in an extreme situation of full risk. Now, if I sold some calls, if I sold my calls, and then I used this money, say it was $10. Okay, say this was 50 in my total. Then I sold some, so minus 10 equals. So now my my options are only worth 40. Since this is extremely volatile, highly volatile. This is owning the underlying security. Underlying security is still volatile, but it is far less volatile than owning the calls. So by subtracting the 10 and just buying this is less volatile, I'm kind of diversifying. Even though it's the same stock, there are two different levels of volatility. So I'm less prone to. I'm in a less risky position. What time is it? I have class at from 5. Oh, it started at 5. Yeah, okay. I guess I'm not going to class then. I think it's 5:19 right now, and it starts at 5. Okay, that's fine. Highly volatile. So this is less volatile. And I'm doing this because I'm not holding it for the long term because I think that there's just been, it's down like 99.9 something percent. The market cap is so low. I think they'll do a chapter 11. I think they'll just be sold for parts, But we'll see what happens. They report on Thursday. Today is Wednesday. Oh, they report tomorrow. Shoot, after hours. So my calls, some expiry date for some calls. This is my personal positions. Are on December 22nd. Others are. Let's erase this. Others are at November 17th, and then others are at January something. I'm not sure what that is. So what does that mean? Well, that means that the theta is far higher for those 11-17. So if the stock goes up, I need to sell them immediately because theta is time decay. So the closer that you get to expiration, the more your stock drops because there's less of an opportunity because the time horizon has shrunk. So say you buy it, say just purely hypothetical, on January, you buy a call. This is supposed to say January, and then you buy a call for December 31st. and you buy this on January 1st. The market is open January 1st. Market doesn't open on December 31st. But let's just say you do. So you buy a call, buy one contract of one call. Now the theta is very low. And this is what theta looks like on a graph. So it goes like this and then like this. So over here, you have the most opportunity. Oh, let's adjust you. Can you see? Okay, hold on. Oh, I could have been doing this the whole time. Wow. Okay, so you buy one call on, you know what? That's actually, because now you can't see the ticker. Okay, so you buy one call. So you have less of so in January 1st, say you buy a call, it's trading at $20, and the strike price is $25. Well, from January 1st to December 31st is the highest chance for the call for the price of the stock to go from 2025. The highest chance in this whole time horizon. Now, say you get to November. So let's say November 2nd. I don't know. So you're on November 2nd. Now, say the stock is still at 20. Well, what are the odds that it's going to get to 25 by December? It could, but the chances are exponentially lower. So this was January, now you're here. The chance of getting, this is December 31st, right? So the chance of getting is very low. So the time decay is huge. The theta is huge. So the closer you get to expiration date, the higher the time decay. Now, let's get rid of this so we're not confused. This is just an example. So if the Groupon beats, I'm going to sell the calls. Now, equities, the stock does not have a time decay because, well, I guess Judgment Day would be time decay, but there is no time decay because you can sell it whenever you want. There's no price. You're not betting that it's going to reach a certain price. You might have an objective for it to reach a certain price, but there's no contractual obligation that it has to meet that price. You can set a goal for yourself, but you didn't buy a contract that says that it's going to reach this price. So yeah, so if it beats, I'm going to sell those calls. I'm going to sell these calls because they have the highest time decay and they have the least chance of reaching the strike price. Now, the strike price at the bottom are all different, so the more diversified. So if you have different strike prices, even though it's the same underlying security, you have different strike prices, you're more diversified because if you go all in on one stock, if you go in on one contract, you buy 10 calls on one contract, then it's not, you're fully betting on one thing, which is the opposite of diversification. So I'm going to sell these, so I'm going to get rid of these if they beat. And then if they beat, maybe they go a little higher, then I'll get rid of this. Eventually I'm going to exit all of them because eventually you have to exit every option, right? So yeah, so others are, what is that, right? Oh yeah, somewhere like January something. I don't even know what they're at. So yeah, this is how you do this went way further off than I had anticipated. So this is Groupon. I'm doing a short-term bet, but I think it has a big problem. Maybe in the short run they'll benefit from COVID. From inflation, but once inflation starts to cool, maybe. There'll probably be high customers, but the chance of retaining them after inflation cools down, because we already saw the opportunity for Groupon to attract consumers. Say it was in a low inflation environment, they couldn't do it. So they've shown they couldn't keep them. So if they could potentially have high customers during this inflationary period, but the odds of them retaining them are very low because they've shown that they couldn't do it. So for now, I'm betting it personally because it's such a smart part of my portfolio. I have that luxury of being able to, even if it goes to zero, it has a small effect on my portfolio. But you know, it's up to you. It's up to your judgment. This is not a huge buying signal. It's basically the point that I'm making. Should I say this is not official financial advice? I don't know. I'm just showing you some math, man. I'm not doing financial advice. I show you math and what I did and what. I'm not telling you to do anything. I'm just explaining to you my position and the math. So that's it. Yeah, I might do this again. I might never do this again. Who knows? So yeah. All right. Thanks.